This is the Police Officers Credit Union Association session on the coronavirus pandemic update. We're going to be talking economics, which is everybody's favorite subject, especially now. And we have two distinguished guests. Both of them from one of our valued business partners, which is Stifel. We have Frank Santucci, who is on camera with the very classy Stifel background. He is a managing director for Stifel. And we also have Dr. Lindsay Piegza. I think I got it right. We tried to practice it beforehand. I think I got it right. She is the chief economist for Stifel. So we're going to learn a lot from them. Hopefully, and pardon my French ahead of time, we won't be too screwed in the economy with the pandemic and the Great Depression that we may or may not be in. But you don't want to hear from me or hear my opinion. So I am going to turn it over to these folks. Frank, Lindsay, take it away. We want to hear about the economy.
Fantastic. Well, thank you. And thank you to all our callers for joining us today and giving me this opportunity to provide an economic update. I think as the timeline extends now for containment of COVID-19, investors are beginning to understand the dramatic economic costs materializing now as a result of shutting down the domestic economy. We've seen continued massive volatility in equity and credit markets, and arguably this has compounded the need for further government and central bank intervention to stabilize the economy. Although at the latest FOMC meeting, the Fed essentially took a step back from its persistent crisis management mode, or at least a pause in the onslaught of initiatives that we've been seeing on a near day-to-day basis. There was no further reduction in rates, no adjustment to quantitative easing, no announcement of any additional liquidity programs. Although, to be fair, at this point, the Fed has already committed to unlimited asset purchases, as well as to provide liquidity to essentially any market deemed necessary. So as you can see on slide 4, rather than launching new initiatives, the central bank simply reaffirmed its commitment to both ongoing aggressive action to support an eventual recovery and perpetually low rates until the economy is, quote, back on track. Now, in the statement itself, the committee offered a relatively tough assessment of what's going on here in the U.S. economy, noting that the virus is causing tremendous human and economic hardship across the country and around the world, for that matter, resulting now in steep declines, they say, in economic activity and a surge in job losses. This reduced characterization of activity, while certainly accurate, is furthermore in line with what we saw in terms of that first look of Q1 GDP, as you can see if you turn to slide 5, please, down near 5%. This is a larger than expected drop in activity at the start of the year, and it really solidifies the realization that the U.S. economy was already heading into recession at the start of the year, and yet the brunt of the pain is yet to come as we await those Q2 GDP figures. And I will walk through a more formal forecast in a bit more detail at the end of the presentation. On the inflation front, the statement from the Fed noted weak demand and significantly lower oil prices, holding down consumer price inflation. Turning to slide 6, you can see that downward momentum. So despite ample spending by the federal government and unprecedented liquidity being pumped into the market by the Federal Reserve, the risk of rising inflation remains low, according to the chairman, Jerome Powell. Given the disruptions, he says, to economic activity, both at home and abroad, remember this is a global pandemic, regarding consumption, investment, and the flow of credit to households and businesses. And in fact, with the downward pressures that we've seen on inflation well established for several decades so far, the chairman actually suggested, and we would agree, deflation was potentially or is potentially a more pressing concern than an upside risk of inflation. Of course, as I mentioned, while no new actions were taken last week, over the past 2 months, I know it seemed a lot longer, but it's just been about 2 months now, the committee has taken extraordinary actions And turning to slide 7, I've just outlined a few here. We certainly don't have to go through them, but the idea is the Fed has taken extraordinary measures to provide market liquidity and ensure access to credit for millions of businesses and individuals in need. Remember, it was starting on March 3rd that the Federal Reserve lowered rates effectively to zero, taking the federal funds rate down 150 basis points in a series of emergency moves, if you remember, to the current range of 0 to just 1/4 percentage point. The Fed is also, as I mentioned, committed to unlimited asset purchases. That has already totaled more than $1.5 trillion and $250 billion in terms of Treasury and MBS purchases, respectively, taking the balance sheet now to $6.5 trillion, the Federal Reserve's balance sheet to $6.5 trillion. The Fed has also launched a total of 10 liquidity and lending programs. So taken together, these policies, again, they're aimed to keep businesses and households afloat. And as the chairman told us, again, remain critical for a strong potential economic bounce back. Yet despite these extraordinary steps that the Fed has taken, and by the federal government, let's not forget a $2.2 trillion aid package, the largest in history, there remains the question as whether or not this myriad of policy initiatives has been successful. Or maybe better said, is it enough at this point to support the faltering U.S. market? Now, there has been some relief in terms of the credit markets, but Main Street, as we know, continues to retreat under the pressures of a forced economic shutdown. In fact, even after accounting for these unprecedented steps, both on the monetary and fiscal side, let's turn to slide 8. Many Fed officials are still looking for a potential 30% decline in the second quarter, maybe more, and a peak unemployment rate well above 10%, or well above the peak that we saw during the financial crisis of 07-08. Remember, the lockdown at this point is roughly estimated to be costing the U.S. about $25 billion with a B in lost household income and revenues per day. And despite these seemingly generous loan programs, if you can turn to slide 9, there is an estimation that about 40% of small businesses will still be open or still expect to be open by the end of the year, with already 1/4 of small businesses reporting that they have closed, at least temporarily, but many reporting closed for good. So health ramifications aside, just putting the pandemic and the fear of getting sick to the side for a moment, when we look at the economic consequences, spiking unemployment, rising business closures, all of this occurring amid an increasingly slow containment of the virus, as the lockdown measures for many states have been extended through mid-May into June. Some states have taken steps to relax those measures, but again, there are a number of states that have actually extended these stay-at-home orders. So at this point, the prospects of a sharp rebound, as some Fed officials have suggested is possible, seems to be far outweighed by the more realistic prospect of a longer-term structural disruption to the U.S. economy. In fact, let's just take a look at some of the latest data points, which are already providing a strong counter-argument to a V-shaped rebound. Going to the labor market, for example, turning to slide 10, please. Another 3.2 million Americans filing for unemployment as of the report this morning, following last week's report of 3.8 million. Looking at the 7-week sum, claims now total over 33 million. Just to put this in perspective, this is more than 40 times the previous peak that we saw back in 1982, which was roughly around 700,000. And this increase isn't necessarily expected to slow quite yet going forward. The first round of layoffs reflected a lot of the closures in the service industry. These were hotels, malls, restaurants forced to close to prevent the spread of the virus. But the second wave coming down the pipeline now is impacting those that were thought to be able, essentially, to effectively work from home. So we're talking more about lawyers, government employees, healthcare workers, or at least those not on the front line. On the consumer side, remember the consumer being the lifeblood of the economy. Let's take a look at slide 11 and see how the consumer's doing. Retail sales plunged nearly 8% in March. This is the largest decline on record. And just to put this in perspective, again, sales fell as much in March, the latest report, as they did during the worst 3 months of the 07-08 recession. And this is despite massive stockpiling of food, basic supplies like toilet paper. In fact, food and beverage sales in the same month of March, rose 25%, but it was weakness elsewhere that more than offset this increase. And as we saw in that first look of Q1 GDP, a near 8% drop in quarterly consumption. So this was actually more than twice as fast as the worst quarter during the financial crisis. One more piece of the latest data, if you would turn to slide 12, the New York State Manufacturing Index fell to an outright startling negative 78.2. Now, this is a record low, twice the previous low that we had previously had on record. If you're not familiar with this index, it's not a big deal. Essentially, the takeaway here is that what we've seen is unprecedented declines across different sectors of the economy in terms of orders, shipment, employment, hours worked. Now, nothing in this report should necessarily be unexpected. But again, these data points remind us of the consequences of the policies forcing an economic shutdown and again, stalling entire sectors of the economy. So as we look at the economic footing of the U.S. economy, and it continues to deteriorate, the question remains, is there more the Fed or the federal government can do, should do? And some have answered this with a resounding yes, as we see on slide 13, some calling for negative interest rates, at least on the monetary policy side, some calling for further government stimulus on the fiscal side. But for now, I would argue that it makes better sense that the Fed would actually focus on the initiatives already in place and continue to work with the federal government to push funds out to workers and businesses that need them, as well as local governments reeling from lost revenues. Although it is vital to make a distinction in all these cases, remember, taxpayer dollars at this point in these programs are intended for legitimate small and mid-sized businesses that are facing temporary liquidity constraints and then don't have access to capital markets. So these aren't intended for large corporations. On the flip side, for local governments, these are also funds that are intended for municipalities and local governments that are struggling because of the forced shutdown and not necessarily because of lingering liabilities from the past. For example, looking at the state of Illinois, as you can see on slide 14, Illinois requested $44 billion in COVID-19 aid, but less than $10 billion of that would actually be allocated to local municipalities, reeling again from the loss of local revenues. As we know, at this point, monetary and fiscal leaders have already released massive expenditures to stabilize key sectors and players, initiatives that I think many of us would agree were or are necessary, or at least they appear to be the only option at this point to help stem the fallout from a forced economic shutdown. But while these actions may be beneficial in the short term, they may also be creating a massive barrier to growth once the economy reopens, not to mention severe moral hazards, or in some cases, outright fraud, really mitigating, I think, the incentive for any further deployment of funds or credit. Overall, I do think it's helpful that we remember this is a health crisis, not a market crisis, meaning the best medicine by far is containment of the virus and a return of public confidence. So while the pandemic may eventually end, the consequences of these policies put in place, we are fearful may prove longer lasting. Again, as we see businesses contemplate possible permanent closure, families struggling to pay rent, put food on the table, all along the way, the longer we stay shut down, valuable savings and resources are being exponentially depleted. And as a result of this forced shutdown, this is creating devastation on balance sheets, mounting debt at all levels, individuals, businesses, governments. So we do worry that this will be an irreversible negative consequence in terms of impacting the productive potential for the country, damage that unfortunately is unlikely to be rectified even if we do see a near-term suppression of the virus. Just to give you an example, moving to the federal level, so moving off of Illinois and going to the country level, on slide 15, adding in $4 trillion from the Federal Reserve, the American government has already committed more than $6 trillion to arrest the COVID-19 pandemic. So this is essentially putting us in the position where the nation will owe more than the economy can produce in a given year. This is the first time this has happened since World War II. But back then, switching from wartime production, we were embarking on a decade-long expansion of 4.5% growth. This time around, going into the pandemic, the US was already facing a reduced growth rate of around 2%. So going forward, with a permanently crippled economy, we will not be able to organically grow ourselves out of such a massive debt burden, further retarding then growth for years to come. So again, the actions taken by the Fed and federal government may help bridge this near-term gap, but we have to be at least mindful of the potential limitations these policies put on the capacity for the economy to succeed in the longer run. Overall, I would say that right now we remain optimistic that the pandemic will eventually be contained and the US economy will eventually reopen for business in the coming weeks or months in the worst case scenario. But the prospects of returning to normal are hardly a given. It is going to take time for businesses to reconnect with workers and supply chains. And on the demand side, without widespread testing, accurate, meaningful testing capabilities, consumers, the lifeblood of the economy, are going to remain hesitant to re-engage in the marketplace within close contact of others. So again, without a clear ability to separate the healthy from the sick, even if we're permitted, many Americans are going to continue to curtail spending and consumption as a result of both lingering fears and crippled finances. So overall, turning to the final slide, slide 16, if you would, you can see our forecast grid here, just giving you an updated outlook for the U.S. economy. We do maintain, as I mentioned early on, that the second quarter will be the hardest hit, with growth deteriorating at roughly a 30% pace April to June, solidifying those recessionary conditions that were already set in place after a 5% drop at the first look of Q1 GDP. Now, assuming a subtle reopening of most states, if not the broader economy by June. So remember, there is a time element that we're factoring into this forecast as well. We are optimistic that the third quarter will usher in a more positive outcome amid restrained, but still somewhat pent-up demand for goods and services. Now, you can see here, third quarter, we're looking for about a 10% improvement. This may seem like the beginning of a V-shaped recovery, but I would caution against such overly optimistic interpretation. Growth, if you remember, is calculated quarter over quarter. So on a relative basis, even modest improvement from those Q2 lows will appear larger than the realized nominal gain, simply going from terrible to not quite as terrible. Going into the end of the year, growth is likely to falter back into negative territory as a result of both restrained consumption or a potential second round flare-up of the virus, resulting in minimal growth for the foreseeable future throughout 2021, even below that lackluster 2% pace that we saw at the end of 2019. Unemployment, we do expect to peak around 15%, but then remain elevated around 9 to 10% for the next 12 to 18 months. We also expect that depressed level of consumption, both at home and overseas, to lead to significant price deterioration, if not outright deflationary conditions, as the chairman talked about in the latest FOMC press conference. We do expect these conditions to force the Fed to the sideline indefinitely, perpetually benchmarking rates to zero, at least for the foreseeable future. Now, I do want to caution that looking at this forecast, as you might imagine, the goal here is to provide a general expectation as to the pathway of the economy. These are unprecedented times. There are countless risks and uncertainties in today's environment. So the idea that we would pinpoint the exact level of growth or inflation is virtually impossible. And that's not our intention. But again, what I wanted to do for this call was provide important guidance as to the expected shape and more broadly, that directional momentum that we see bringing us to a relatively tepid and unimpressive recovery. Now, with that in mind, I do know that times are tough, but we have worked through tough times before. And if there is a bet to be made, it certainly is on the resilience of the U.S. economy. The U.S. remains the largest, most liquid market with one of the most entrepreneurial labor forces in the world. So again, while times are tough right now and the outlook does seem relatively bleak, if there is one economy that could weather the storm, it will be the U.S. domestic economy. But certainly patience is required as we are in unprecedented And I think it's very warranted to use that word. A lot of times it gets thrown around, but in this case, it very much is applicable. We are in unprecedented territory. And with that, I will pass it back over to my colleagues. Thank you again.
All right. Well, thank you, Dr. Piegza. Dan, give me a thumbs up if you can hear it. You guys hear me okay? Everybody all right? Yeah? Okay, good. All right, so moving forward here, off of the economy, wanted to talk about the impact for credit unions. And just so everybody knows my background, I've been working with credit unions for the last 35 years. I'm the principal author of the credit union ALM model that Stifel Nicholas uses. So I spend a lot of time talking to credit unions, talking about their loan portfolios and deposit pricing and investment strategy and how do we grow market share and all of those kinds of things. So put together a couple of pieces of this presentation. Wanted to talk about what's different this time, start with some good news. What are some of the things that are going to make this not as bad as it otherwise would have been? Then I want to talk about looking back at the last recession, the Great Recession, and what happened there. The biggest risk that we have at this point is in our loan portfolio, right? For folks that are out of work, for delinquencies, for charge-offs, and the negative impact to earnings and capital from that. So I want to show what happened last time, and I think people are craving a little bit. How do we make an educated guess moving forward? How bad could this be? And I found just blindly guessing about the future doesn't do a lot of good. I really prefer to look back at prior scenarios and use those as kind of a benchmark to start from. I just find that to be a better methodology, if you will, for forecasting. And then I've got a couple of ideas too, so we'll jump right in here. Let's start with some things that are different in this crisis compared to prior crises. Of course, this was a snap your fingers deal, right? In March, we just woke up and, okay, we're shutting everything down. That's never happened before, right? The last crisis actually started at the very end of 2006, beginning of 2007. It didn't really hit rock bottom for 2 years till the end of 2008. And the recession fully didn't flow through the economy until 2009, early 2010. So it was a 3-year slow grind down in terms of impact on credit union balance sheets. This time, snap your fingers. We went from the strongest economy ever. And I know that sounds like hyperbole, but if you look at our gross domestic product coming into the first quarter of this year, it was far and away the largest economy ever in the history of the world. Unemployment was at an all-time low. Consumer sentiment was at a 15-year high. Credit unions were just killing it. They were doing great. Double-digit loan demand year over year, auto loans, mortgage loans, delinquencies were way down. Everything was going just swimmingly. And then the pandemic hit, right? So the Fed, of course, has passed the CARES Act on March the 27th. The Fed has dropped Fed funds to 25 basis points. Stimulus checks were delivered within 4 weeks, and unemployment checks, including an extra $600 a month per person, extended through July of 2020. Certainly the Fed lowering Fed funds to zero is not unprecedented. We were just there 5 years ago. The government passing relief bills, not uncommon. The stimulus checks have been done before, and certainly unemployment and extended unemployment have been done before. So all of those things are normal responses, if you will, but there are definitely some things that are new and different this time around. For example, NCUA encouraging all credit unions, every credit union, to offer loan deferments, and more importantly, the accountants. And this has never happened. I almost fell out of my chair. The accountant, is anybody on the phone an accountant? No, hope not. CPA? Okay, good. All right, so accountants are really, really, really reluctant to change accounting rules because of emergencies. They just don't like to do it. This is the way the accounting is going to be, and it doesn't really matter what's going on. This time, they jumped right in. This was really, really a big deal. They said any loan where the member asks for a deferment of up to 6 months because of COVID-19, you don't have to report that as a delinquent loan. More importantly, you don't have to report that as a troubled debt restructuring. We can simply defer the payments, treat it as current. You don't have to set aside reserves. You don't have to report that delinquency. It's okay. 6 months later, we'll deal with the loans that are really in trouble versus the folks that are able to come back. That's never happened before. The NCUA making low interest emergency relief loans, increasing revolving lines of credit for members, encouraging more payday alternative loans, which many credit unions don't write, and of course, encouraging people to waive late fees. These are things regulators don't normally do. That's something that's different this time around, and that's all for the benefit of the member, certainly, and the benefit of the credit union as well. It's going to make things, in terms of the second quarter performance, make things look better than they otherwise would have. It also muddies the water a little, quite frankly. When we look at data and we see how people are performing, it'll be tough to get a sense of what's really going on because all of those deferred loans will not be reported anywhere. They'll be held very closely within the credit union's financials. The other thing that's different here, unprecedented, is the Paycheck Protection Program that was rolled out by the U.S. Treasury and the SBA. So I thought this was brilliant, by the way, on the part of the administration. So we've got all of these employees that have lost their job, at least temporarily, through no fault of their own. So those folks are going to go on unemployment. One way or the other, they're going to go on unemployment. Well, if those businesses go out of business, when this thing turns around, they're not going to have a job to go back to. So how do we keep the business afloat and keep those employees associated, tied to those businesses? So when they come back, those employees will be there. And the PPP program is designed specifically to do that. They deputized, not my term, somebody else, I heard that on a conference call using that phrase, and I thought it was perfect. The Treasury Department deputized every bank and credit union in the country. They just said, hey, you're going to distribute this money for us because we, the SBA, can't handle all of the applications. Look at the table at the bottom of this slide on page 20. There were 1,661,000 loans that were reviewed and approved and funded in 2 weeks. That's amazing. The SBA could never have done that on their own. Never. Impossible. It's all the banks, all the credit unions in the country jumping in and doing that. I believe there were 685 credit unions in round one of PPP. Preliminary, this data here is all round one. We're now in the middle of round two.
Oh, Frank, did we lose you? Frank, we lost your audio. While we're getting Frank back here, I promise you that I did not arbitrarily mute him. Yep, we see your finger, and it is the correct finger to be showing on camera, so you're good. Let's see. Let's make sure we got him here. we go. Frank, did we get you back?
Yes, I'm back. I'm
Terrific.
back. Can you hear me okay?
Yes, we can hear you.
I have no
perfectly.
idea. Good. I have no idea what happened there. Apparently, I said something that the government didn't like, so they cut my phone. So
That's possible, but you're good now. So continue.
okay. All right. Good. Apologize, everyone. Thank you for your patience. So again, remarkable job here with the PPP loan program. It's going to make a big difference. It really will. So that's the good news, is that, you know, the government is all in terms of trying to help reduce the negative impact of this. As Dr. Piegza said, however, for everything that they put in, if we think about our gross domestic product dropping by 30%, GDP dropping by 30%, that's more than the $2.5 or $3 trillion the Fed has thrown at this problem, along with the fact that money spent by the government never fully makes it into the economy. There's always waste along the way. There's always expenses along the way, so that not all of that is going to actually turn into economic activity. And of course, there are some folks that didn't get PPP. There are folks that are not getting enough in unemployment to really make it. So let's take a look at how bad could this be. And the number one concern here for credit unions has got to be loan delinquency and charge-offs, and coming up with the right provision for loan loss. How much money do we need to set aside for these losses? So this is a chart looking at the yellow line at the bottom here is the credit union industry. This is every credit union in the country from Navy Federal on down, mashed together into one giant, now $1.5 trillion credit union, right? So delinquency down at the bottom, unemployment rate at the top. And what you'll see here is a very, very strong correlation of 0.94%, right? The highest that number can be is 1.0. So if credit union loan delinquency moved exactly month by month with the unemployment rate, we would have a 1.0 correlation. So we're very, very close to that, very close. Unemployment very clearly is an impact on credit union loan delinquency. When we compare that to banks, what's interesting, right? Banks peaked, their coefficient is at 0.98, even more correlated with unemployment. And what's interesting is if you look at the differential there, credit union delinquency peaked at the end of 2009 at right about 1.8%, right? Banks were more than double that, almost 4.7% in the last recession. So substantially more in way of delinquency in the banking industry. And I think that has to do with the fact banks had many more mortgages at the time, which of course it was a financial crisis because the housing market blew up. So I think that explains that differential there. When we look at delinquency versus charge-offs, delinquency is the top line, the yellow line here, charge-offs, the blue line. No surprise, these two things are very strongly correlated as well, right? As we have more delinquency, we've got to charge off more bad loans. So those things are very, very tightly correlated here. You see the peak, again, in delinquency at 1.84% of total loans. The peak charge-off at 1.21% of total loans. So for every $100 of loans on the books, there was $1.84 delinquent. For every $100 of loans on the books, we were charging off $1.21. I mean, that's a really staggering statistic. That's as bad as it's ever been. That would make if the average credit union had to do that today, they'd be unprofitable, right? That's how much of an impact that charge-off is. Now, again, normally, you look at the normal times, in the gray here on the far left, far right, normally we see delinquency rate running about 0.7, sometimes 0.6, sometimes 0.8, in that range, but roughly about 70 cents for every $100 of loans. That's normal. When we look at Charge-offs, normally about 40, somewhere in the 40 to 50 range, sometimes 60, et cetera. But you can see, again, that correlation between the two. That's normal. But you see that big bubble right in the middle. That was the financial crisis. So how bad could this really be? When we look at the impact on earnings, delinquency rate at the top and provision for loan loss at the bottom, not quite as strong a correlation here. Credit unions tend to be a little bit slow in setting aside their reserves. Historically, they have been slow. What's interesting is when you look there on the far right, look at how the delinquency rate was dropping in 2014, 15, 16, but our provision for loan and lease loss was actually going up, right? No correlation. In fact, moving in opposite of each other. The reason for that is CECL, the new accounting standard that's supposed to take place. It was supposed to take place in 2018. They pushed it to 2020. It's now 2021. So credit unions have been increasing reserves in anticipation of CECL. And the result is that they've got more reserves today than they otherwise would have. Very lucky, in fact, that happened. That will help cushion the blow somewhat. So again, how bad could this be? You look at the blue line here is unemployment rate. You've got the big spike at the bottom. We're going to get our first sense of it tomorrow, right? Labor Department reports the March unemployment rate tomorrow. Interesting to see where that number comes. Dr. Piegza is forecasting here for the unemployment rate likely in the month of April, or for the month of April, to be somewhere in the 25% range. That is a staggering statistic. So again, I went too far. There we go. In normal times, a credit union's delinquency ratio is 0.7, provision for loan loss at about 0.4. During the last crisis, it peaked at 184 in delinquency, 113 in provision. In other words, delinquency went up by 2.6 times and provision went up 2.8 times. So if you think about your credit union and where your delinquency rate is today, multiply that times 3. It's roughly what the last recession would have been. Again, take your allowance for loan loss, multiply it times 3. It's pretty much what happened last time around. Last time around, unemployment only peaked at 10%. If we're going to peak at 20 or 25, does that mean delinquency is going to be like banks were last time at 3.5 and provision at 2.2? That's possible. I don't think it's going to be quite that bad, but that's possible. Now, again, we're given a little bit of reprieve this time around, right? Again, you've got the $600 unemployment checks through July of 2020. There are a lot of folks that are getting those checks that are making more money now on unemployment than they made before. So certainly, hopefully, those folks are going to pay their bills now that they've got a little extra money. But we've got the stimulus checks. We had the extra unemployment. You've got the PPP program. The Treasury is working on their Main Street lending program. We've got some states where the economy is, quote unquote, starting to open back up, slowly but surely. So all of those things argue that it may not be exactly the same correlation this time as last time. Also, the last bullet point. We think that correlation will still be there, maybe not quite as strong, but it's definitely going to be delayed. These programs are all temporary. Those $600 checks end in July. The stimulus checks are a one-time deal. The deferrals on loans are going to end in 3, 6, 9 months. The payroll protection program will be done by tomorrow, more than likely. So at some point, if the economy does not really come back and stand on its own, that correlation will come back. And we may see it in the fourth quarter. It's just going to be delayed. That's what we expect to have happen. A couple other things that are different this time than last time. Right? Indirect auto loans are a much higher percentage of total assets, almost 15% of total assets compared to under 10% last time. I'm not really concerned about that. I'm highlighting it. There's really not a big difference in delinquency and charge-off between indirects and direct loans. A lot of people think directs are safe, indirects are unsafe. That's not really true at this point, statistically anyway. As long as you measure, monitor, and manage your indirect dealer relationships, you should be fine. Certainly commercial loans, bigger this time than they were last time, but it's only 5% of total assets, so it's not a huge deal. Looking at mortgage loans, first mortgage loans at 30%, almost 50% higher than where they were last time. That's a little bit of a big deal, I think. And participation delinquency is way down, which is nice. So we've got some additional exposure this time we didn't have last time, real estate and commercial loans in particular, maybe indirects as well. But overall, not substantially different, right? So what are some things you can do now? Number one, unfortunately, we need to tighten our lending standards. I know we're here to help the member, and we can't lose sight of that. Sometimes bad things happen to good people. And one of the beauties of credit unions, I've been a credit union member since I was 8 years old. I got my first car loan from my credit union. I got my first,
Frank?
I'm here, but I lost, oh, there we go. Okay, good. Yeah, miracles of modern technology. Can you see the screen okay?
We can see you. We do not have your PowerPoint on there.
Let me share it again.
Yeah, I think that should work. Let's try that.
I'm sharing.
All right, Sharon is Karen. Go for it.
Yeah, there we go. Where do I want to get to? I got to go back a couple slides. There we go. Okay, so as I was saying, you know, I've been a credit union member since I was 8 years old. I got my first car loan from my credit union when I was 20 years old, and I had no credit, and they took a chance on me. You know, my first mortgage, my first home was financed by my credit union. So, you know, one of the things we're here to do is certainly to serve the underserved and help the underbanked. And that's more important now than ever. And those are certainly judgment calls you need to make. But generally speaking, you cannot across the board just say, hey, we're going to make loans to anybody because everybody's in trouble. You do have to try and protect the credit union as well. And in talking with banks and credit unions, we are seeing that they are tightening lending standards at this point and being a little bit more picky, especially on some of the more esoteric type of product. You really have to monitor your deferrals during the deferral period. Take the fourth bullet point here in terms of collections. You know, you've got your loan officers right now are relatively slow. Outside of real estate and the PPP loans, loan demand is relatively slow. So take those loan officers and turn them into an outreach team. Have them contact folks that have gotten deferrals on their loans during the deferral period and just check in. Hey, we're just checking in. We're your credit union. How are you doing? How are things going? Have you gone back to work? Is there anything the credit union can help you with? Just monitoring those deferrals. And especially when that first payment comes due. So month 4, that member is now going to go and make their first payment. If you don't get that payment in 5 days, pick up the phone and call them. Hey, just checking in. How's it going? Everything okay? Do we need to do another 90-day deferral? Is there anything we can do to help you? You need to really micromanage that process. Same thing with the provision and your allowance for loan loss. You know, use those correlations I gave you before in the slideshow here in terms of unemployment versus delinquency versus provision for loan loss. You can go and see how closely your balance sheet reacts to that unemployment rate, just like I did for the industry. Use those statistics, use analytics to help you guess so that you're not under-reserved, certainly, or wasting money by being over-reserved. And finally, work with members to restructure their loans. At the end of the day, after the deferral's over, you know, some of these folks may not be coming, they may go back to work, but their savings are gone. Things are going to be a little bit tight. So certainly working with those members to help them bridge the gap is really, really important. Some other considerations beyond provision and allowance. You as Dr. Pieggs has said, we are more than likely going to be in a low interest rate environment for an extended period of time. The Fed has said they have no timeline for when they anticipate coming off of this zero bound for the overnight rate. Well, we were just there, right? We were there. If you look this graph on page 33, the thin red line here is the yield on the 1-year Treasury, which pretty closely matches the Fed fund rate. The blue bars behind it are the credit union industry's net interest margin, right? What do we do as a business? Well, we bring in deposits from our members and we pay them a dividend rate. And we take that money and we lend it and invest it to somebody else at a higher rate. And we live on the spread. That's our margin, right? Well, look what happened as interest rates were bouncing along the bottom on the left-hand side of the graph, right? We came crashing down in 2008 as Wall Street blew up, as the housing bubble had burst, and it put us into the Great Recession. And then we bounced along with Fed fund rates at zero from 2008 all the way until the end of 2015. So this was 6 years of zero interest rates. We just went through it. Look what happened to credit unions' margin. Margins came crashing down from 370 all the way to 324. And we waited and waited and waited for rates to go up. And then finally, as the Fed started raising rates, you saw Treasury yields go all the way up to 263. The Fed fund rate was all the way at 2.5. And look at credit unions' margins. We're like a boat on the ocean. Rates go up, credit unions make more money in margin. Rates go down, they make less money in margin, right? And you can see that very clearly. Look at the far right-hand side of the graph. Treasury yields have come crashing down. The Fed is back to zero. What do you think is going to happen to that margin? It's headed back to 324, right? We don't have significant room to cut dividends. Most dividends are still relatively low. We're going to see investment yields drop under 1%. We've seen loan yields come down as well. Lack of loan demand as well. So we're looking at that margin getting compressed fairly significantly. So that's less earnings, right? So we're going to have to set aside more money for loan losses. At the same time, we're going to have less earnings. When we look at this impact on ROA, the next graph on page 34, we've added another line. We've got two other lines on here. The red line here is the provision for loan loss. So on the left-hand side, you see the big spike in provision for loan loss. The green line is ROA. So as we take money out of income and put it into reserve to charge off those bad loans, our income comes crashing down, plummeting. Then as our delinquency slowed, we charged off all of the loans, and now we can cut that provision, and you see earnings go right back up. And then as at the tail end, far right-hand side, we start to see, that provision for loan loss going back up again, and you see earnings come crashing right back down. Now, there's another impact on that yellow cycle. So earnings are coming under pressure from tighter margins, right? Less spread between what we're earning on loans and investments versus what we're paying in dividends, and that's going to get worse. Our provision for loan loss is getting worse, and it's going to get even worse from here. Probably delayed a bit, some of it delayed until fourth quarter, so we can spread it out over the next year, but it is going to get worse. In addition, we've seen a collapse in fee income. Right? People aren't spending money, so we're not getting interchange income. And one credit union I talked to yesterday out of Chicago told me that they count on their overdraft income. And it's a big piece of their earnings, about 1% of return on assets, 1% ROA, just from overdraft income and courtesy pay. They said it's down 75%. These people are sitting at home. They're not spending money. So they've gotten in their stimulus checks. They got in their extra $600, and they're not overdrawing their account. And the result is 75% reduction in the first quarter. And that's in the first quarter, 75% reduction in their overdraft income. So earnings are going to be a challenge. So what do we do? Well, The first thing we have to consider is liquidity, right? This two charts here, two graphs at the bottom here. The red line is loan growth. The green line is deposit growth, right? So on the far left, you see the tight liquidity. This is back in 1999, right? So we're going back 20 years. Tight liquidity. We see deposit growth spike and loan growth drop after 9/11. Then during the housing bubble, it reverses. We see loan growth go up, deposit growth go down, right? Competition from the stock market, et cetera, during the housing bubble. Then, as we go into the Great Recession, you see excess liquidity, right? Every time there's a crisis, deposit growth spikes, loan demand drops, and we get excess liquidity. Again, we had tight liquidity during the recovery, and the far right, COVID-19, you can see that switch happening again. So loan demand is down, we're going to have more liquidity. Deposit growth is up, we're going to have more liquidity. It's also, growth in deposits here from those one-time checks in the $2.2 trillion CARES Act, right? We take 75% of those checks are distributed. So assuming not all of that money goes out, so $220 billion of liquidity being sent to bank and credit union checking accounts. Let's assume 60% of those that are receiving money are employed, and that money is discretionary income. So that's $130 billion, right? If we assume only half of that is kept in deposit accounts, that's $65 billion. Now, these are all guesses on my part. I have no idea what those splits are really going to be. But the Fed, in a matter of weeks, dropped $65 billion more into checking and savings accounts. On top of that, we saw a spike in mortgage refinancing activity. Mortgage refinancing creates liquidity as people pull equity out of their home. At my house, I was sitting at my closing 4 years ago. I'm refinancing my house. I was going to do a renovation. I'm sitting at the closing. They're like, what would you like to do with that money? Would you like to put it in your checking or your savings or your money market account? So just refinancing my house created thousands of dollars of deposits for my credit union. We're going to see some impact of that as well. In addition, people aren't spending money. I've said it a couple of times. If you look at this table here from JP Morgan and the US Treasury, right? Discretionary spending, air travel, amusement parks, museums and libraries, casinos and gambling, sporting events, things like that. It's $1.5 trillion a year, $1.5 trillion a year in entertainment, right? In disposable income. It's not all entertainment, but you get the point. Well, if only a quarter of that is dropped, right? If we have 1/4 reduction in that, and arguably it's going to be worse than that, but a 1/4 drop in that is $91 billion more in deposits that are going to be left in people's checking accounts because they're not spending the money. Creates more liquidity. Gas consumption. Not only the table here is for the price of gas, right? In America, we on the average year, we consume 142 trillion gallons of gas. That's a staggering number, right? It's 11 trillion a month. So a 25-cent reduction in the cost of gasoline is $3 trillion more, $3 billion more. That's going to be sitting in bank accounts, money that's not spent. Well, the price of gas is down $1.50, not to mention people aren't driving anyway. So who cares where the price of gas is? More savings sitting in accounts. So what do we do? First and foremost, you have to cut dividends. You don't have a choice. I hate to say that. I'm a credit union member. I love getting my dividend from my credit union, but you simply do not have a choice. You have to. Asset yields are coming down. Loan rates are coming down. Investment yields are down. We've got to be able to fund that loan loss provision. We're going to be sitting on a ton of liquidity. The last thing we want to do is go and attract hot money that's chasing high rates. And it's really important. If you look on the table on the right here on page 39, right, on $200 million in deposits, cutting just 10 basis points in dividend rate saves $16,667, right? So if we wait 6 months, right, we would have to cut dividends at that point by 17 basis points to earn the same amount of savings, right? Moving now actually allows you to cut less than if we wait, right? This is not going to be a V-shaped recovery. It's not. This is going to drag on for a year or 2 or 3. The Fed is likely to keep rates low for 4 or 5 years, potentially, just like they did last time. The sooner you cut dividends, the less you have to cut them in the end. So that's to the benefit of your member. It'll save you money in the near term and make your members money in the long term. It's really important. And same thing in terms of investments, right? The table at the bottom of page 40, looking at keeping money in overnights, just letting money sit in overnights versus getting it invested. The difference here, assuming overnights at 1/8 of 1%, 0.125, assuming we can get money invested at 1.2%, which is relatively easy in the investment world. If you're buying loans, you can certainly get up or around 2%. In fact, I saw some mortgage loans trade this morning at 3.25, right? Huge differential in terms of income. So if you look at the lost income by waiting, right, by sitting and waiting, credit unions did this last time. And one of the things I'm trying to emphasize is don't make the same mistakes we made last time. Last time, NCUA was running around like Chicken Little with their head cut off. Rates are rising, rates are rising. What are you going to do? And we sat there for 7 years waiting for rates to go up. Don't make the same mistake this time. If we're wrong, right? If you do something now, you're going to generate that much more income. We've got to figure out how to make up for the lost fees. We've got to be able to cover those bad loans. You've got to stay fully invested. Whether you're buying loans or buying investments doesn't really matter, but you cannot afford to sit at 25 basis points or 0. You simply can't. And what if we're wrong? Well, this is not a zero-sum game. If we're wrong, I hope I'm wrong. I really do. I hope I'm wrong. I hope the economy comes back and unemployment goes back down to 5% or 4% or lower than that. That's the best case scenario. And if that happens, your loan demand will come back. You'll be able to recover the money you set aside for bad loans that won't be there. Your fee income will come back, and you'll be able to take advantage of that rising rate environment. Remember, credit unions make more money when rates go up. So if we're wrong, that's a good thing. What we have to do is manage to the possibility of the worst case scenario. And this isn't even the worst case. I could have painted a bleaker picture, try to be somewhat conservative here in terms of the process. So last thing here, again, a couple of graphs on 41 just showing that differential between staying in cash, that's the thin green line here at the bottom, just staying in cash versus accumulating income by staying fully invested. It is a huge, huge, huge differential. You have to stay invested. Cannot let money sit in cash. And that's pretty much it. Questions?
All right, I've unmuted everybody. We are at the top of the hour, so we will be wrapping this up per se. But is there any, here, let me do this. There we go. Is there one burning question that we need to ask Frank before we go on with our day? And hopefully don't go depressed. I think that what I took away from this is, while we're certainly in a dire situation, there are some possibilities. There are some things that we can do. And of course, before I end this, Frank and Lindsay, we really appreciate you being here. A lot of good information. As with all of our POCUA business partners, I encourage you to work with Stifel and get more insight directly from them. But do we have one important last question before we let everybody go on with their day?
Well, that's either really, really good or really, really bad.
I think, you know what? I'm going to say that you inundated them with so much information, and the hamster is on the wheel. They're all thinking about how they're going to thrive in this new normal coming up. But with that, Frank, thank you so much for a lot
My pleasure.
of great insight. I believe Lindsay had to drop off. A big thank
Yep.
you to Lindsay. But thank you, and thank you to all of you that have joined us. And we'll be all talking again soon here at the POCUA. So take care, everybody. Thank you, and God bless.
Thank you, Ken.
Thank you. Bye-bye.